Hit it.
It's Friday, July 30th, 2021, episode 142. I'm Patrick Ceresna. Now, please note that we recorded this actually on Wednesday, July 28th, so the talking charts will be a few days stale.
And I'm Kevin Muir. This week we depart from the usual format and let one of our regular guests take the interview wheel. We are pleased to present fan favorite Harris Kupperman, aka Kuppy's interview of Josh Young from Bison Interests. Josh has been hitting it out of the park when it comes to his energy picks, and he comes back to the Market Huddle to give us his new ones. Then in Talking Charts with Patrick, Pantaloon of the Pastels, he gives us the latest reading of what the squiggles are telling him.
And then we end with our segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We've got a great show. Lena, hop on. What beer are we drinking this week?
So this week we are drinking Junction Brewery's Junction Tmave Pivo Czech Dark Lager.
Ooh. Tmave Pivo.
Oh, God.
So this may be the one time that Patrick outpronounces things than I do.
Why is this from his part of the world?
Yeah.
I think so.
Yeah.
So inspired by the brewery U Fleku in Prague, I probably butchered that name, that only makes this one dark beer, we managed to get a hold of some floor malted Pilsner malt from the Czech Republic and Czech Saaz hops to make this beer as authentic as we possibly could.
Do you remember those pictures of when the Iron Curtain was over Czechoslovakia and people were, begging for jeans and it was just a horrible place to live?
So you donated your jeans?
No, I'm saying that this tastes like from that era.
Oh my God.
It's terrible.
No, what do you mean? This is still
terrible.
It's just whatever, dude. It's delish. All right. Anyway, give us our side effects.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the Delta dingleberries, crayon poisoning, that one's especially for Patrick, and the braised beefcakes. I kind of like that last one.
Well, listen, let's get Kuppy on this interview.
Hi, everyone. This is Kuppy. It's going to be an exciting episode. I'm interviewing my very good friend, Josh Young, who's CIO of Bison Interests. I've known Josh for a very long time. Whenever I have a question about energy, he's always the guy I go reach out to. And we're at an interesting crossroads here in the world of energy. And I thought it'd be great to just chat it up with him and see how he sees the world. So welcome, Josh. Thanks for joining.
Yeah, thank you. Thank you for having me. And this is a fun change of pace for Market Huddle.
Great. Well, let's just get on into it, I guess. I think most people know who you are. Can you just walk me through where you see the world of oil right now? I know OPEC said some stuff. We see a little bit of drilling coming back. How do you see oil playing out over, say, the next 6 months and 2 years? Where do you think it's going and why?
I mean, that's a great question. I spent a lot of time trying to figure that out. Over the next 6 months is really hard. The shorter the time frame, the harder it seems to be to predict what happens. Unexpected things happen regularly. That's kind of the nature of them. So the longer things go out, the easier it is to see because there's kind of time for things to even out and for unexpected things to have to balance themselves out over time. So right now, the rig count is starting to recover. Frac stacks are starting to come back to work. OPEC is bringing production back online. And there's this COVID Delta variant, which is scaring various governments and getting them to implement failed policies again by locking down their cities or states or countries. So there's kind of a few things that kind of all of those look really negative for oil demand and could throw oil out of balance. But the really big positive is the combination of oil supply capacity being lower than one might think and lower than you see in headlines, and oil demand kind of frustrating news editors around the world continuing to grow at a little bit actually faster than its historic pace of 1% a year, which it's been doing for the last 30 plus years. So supply is actually surprising a little bit to the downside, and demand is continuing to grow at a little bit of a faster than 1%, a little bit faster than the historic rate. So I think things look really good, and I think things look better, again, from a higher oil price perspective 2 years out than they do today, and they might even look better further out than that.
So let's kind of break this down a bit and let's look at the demand side first. Were you surprised with all the lockdowns happening? Are you surprised that oil just hasn't really pulled back at all? It had that 1-2 day window last week, and then it literally just doesn't pull back. Why?
I mean, I think you said it and Kedem pretty well, that, when prices go green with negative news, that's a great fundamental sign. And it tells you that the market's stronger than people think, or than you would think otherwise. So, I mean, there's again, like in the short run, so we're talking about the spot price for oil for contracts that expire on a monthly basis. So that part's actually kind of hard. Like, I don't really know what's driving like this month's oil price. But one thing that does affect it that, again, it's hard to predict, like really hard, and many supposed experts predict it and are nearly consistently wrong weekly. But oil inventories have been falling. And so we finally put out something on it because we saw, I think it was like 5 weeks of draws, and it seemed pretty likely that there were going to be plus or minus another like 5 weeks of really big draws at the same time as, again, some of these experts, or whatever they want to call themselves, research services and subscription services, whatever, we're talking about how, summer driving season was going to come to an end, and how, some of these draws were somewhat surprising, or that they wouldn't continue. And, digging in, it looked likely that the things that were spurring these inventory draws, which was this combination of OPEC production coming on slower, North American shale production coming on slower, or staying flat, and then demand being better again than almost everyone's been projecting. The combination of supply and demand is just such that it's clearing the market, and it's rapidly depleting oil inventories.
So OPEC's obviously watching this, and they kind of surprised the market by, they were talking about not increasing supply for a while, and now they're talking about 400,000 a day every incremental month. What's your view on that? Do you think that they'll eventually overwhelm the market again, or do you think they don't have the supply they claim they have?
Yeah, I think it's interesting. We've been working on this white paper for a little while on OPEC spare capacity. I think there was like a misunderstanding about what was supposed to be happening with this OPEC plus meeting that happened late last month, and I guess got resolved early this month. So OPEC was always planning on bringing more production on incrementally as demand recovered post-COVID, and like that was their deal. So it was just a question of how much production would come back on, and the timing of that production, and the degree to which it remained coordinated by the cartel. And people get upset about calling it that, but that's what it is. It's really funny, right? You see these, like, again, it's just the cottage industry. There's fewer fund managers that invest in oil and gas and energy, but there's still just as many, it seems, pundits and various people that will happily separate you from your money, or from your time, to tell you things that you either already know or just not true. So there was always this understanding that OPEC was going to be bringing on more production, whether it was from the Saudi kind of extra cut that they did, I think it was last November, something around then, or whether it was from kind of their negotiated production quotas starting to ramp back up. So I don't think this is like a huge surprise. I think the really big question was, will they act in concert, or will they kind of fight again? And I think their fight last March scared them. And, it seems like they're very interested, mostly, at least the big producers are very interested in behaving in a coordinated fashion. And since that's happening, and since they kind of need $70 plus WTI and, 75 plus Brent to balance their budgets, I think right now they see this situation as great, not horrible.
How much spare supply do you really think they have? I mean, really, we're talking about the big 4 or 5, but how much real spare supply? Because when you start looking at research reports, and these are by guys that are pretty credible, the Rysteds of the world, it's funny, they all have different numbers. And I guess that's what makes a market. But where's your head on this?
Yeah, and to be clear, I wasn't knocking the Rystads or the energy aspects or whatever. I mean, there are great firms out there. Just they tend to charge a lot for their reports and be kind of quiet. It's the other guys that are a little bit tough. So we've been looking a lot at this, and I think there's like a range of uncertainty, which is why people are putting out different numbers that vary so widely. And I think if you're getting paid some huge amount of money to be a consultant to give an estimate, saying that is unacceptable. But since this is free, and, not going to get anything for this, I can just say, hey, there's a range. So at the bottom end of the range, there was very interesting stuff that was happening over the last few months that people were starting to pick up on, and then everyone's kind of stopped talking about it. So Russia had the allowance to be able to increase their production over the last few months, and they didn't. And so Russia has been underinvesting in their fields mostly since the fall of the Soviet Union, right? They massively overdeveloped their fields. They overproduced them. They hit kind of terminal depletion on a number of fields, and it took a lot of money and time to turn that around. But they have, like, relative to other OPEC countries and their resources, of the fields that they are able to access over kind of the short to medium term, they have the most depletion, the least kind of available likely reserves versus current production. So anyway, Russia didn't grow.
Do you think that's a timing issue where it just takes a lag to ramp back up to 11? Or do you think it's really an issue where they just don't have the capacity?
Well, I think they have, like, the resource, but they don't have the reserves. So there's been massive underinvesting in oil and gas exploration for over a decade now. And so that's one of the things that keeps me interested in the space and keeps me invested, is that there's kind of all of the stuff we're talking about is pretty short-term stuff. There's kind of the bigger problem, which is coming into play in a lot of other commodities, where if you don't explore for too long, you end up running out of your existing proven accessible resources, right? If you never build a new mine, eventually you run out of whatever the ore is that you're mining. And so similar thing for oil. They haven't been building the equivalent of new mines they haven't been looking for them. And of the things that they've discovered, many of them are already on production, or, haven't even gotten started to get onto production. So there's this big lag. So in Russia, there's definitely a lot more oil there, but some of it's undiscovered. Some of it that is discovered is in the Arctic, where it's incredibly expensive, even though they're kind of indifferent to pollution. Ironically, all the US and Canadian environmentalists, they push away very clean, highly regulated production here. And then they, encourage it in Russia, where they just spill, I saw something, there was 1 million, was it gallons or barrels or something spilled in north part of Russia and some lake, and it just barely made the news. No one cared. So anyway, there's a lot of oil, but it's not easily accessible, and it'll take years for them to be able to access it. So it looks like they're in a phase of kind of the point where they've depleted their reserves enough that they might actually have trouble growing their production over the next 6 months to, let's say, 3 years.
Got it. And so you're not worried about them coming online. I mean, you look at the other big guys. Obviously, UAE has made some investments. That's what made the OPEC meeting kind of spicy. Where do you think Saudi and some of the other big guys are? Do they have more capacity? Is their headline number the real number?
I mean, I'm looking at my copy of Twilight in the Desert right now, and I can't not mention that. So, and I know the guys that actually were over there that helped fix the problem that Matt Simmons was talking about in that book, which basically argued that they were massively overstating their reserves, which they were, and they are. But I can hear the sound of the sharpening bone saw right now for me. But they are overstating the reserves, but that kind of doesn't matter. I think, again, it's a lesser extreme problem similar to Russia, where there is some spare capacity for sure. But there's this really weird thing that's happened where whenever Saudi Arabia produces up to, I think they get to 1 million or 2 million below their theoretical kind of claimed spare capacity. Whenever they do that, their inventories fall by a lot. And so, if it happened once, you'd say, hey, maybe that's just weird. There was just some weird timing thing. But every time they've supposedly produced, and it's not even at their capacity, it's at 1 million to 2 million below their stated capacity, their onshore inventories get rapidly depleted. So that tells me maybe they don't have kind of what they're saying. So between the two of them, that's 1.5 million or more potential barrels a day of capacity that's just not there. And for Saudi, it could be 2 million plus, if you really kind of get Matt Simmonsy on on their productive capacity.
So that's a big number because most of the other OPEC, which is oil exporting, a lot of them aren't even exporters anymore. So, as you go down the list of the big guys, it starts really kind of cutting the future exports off, the future capacity. When you look at, I like to joke, and you and I joke about this a lot, but ESG stands for energy stops growing. And it's kind of tongue in cheek, I guess, because these are, especially the super majors, a lot of it's shallow decline stuff. But how do you see that actually playing out? And, do you think, I'm correct in this view?
Yeah, I think you might be, and people don't say this about you very much, I think you might be understating it. So I think, I think there's this amazing thing that's happening where many investment, I think most of this comes down to principal agent problems. So you had the descendants of the Rockefeller, disavow oil and get against drilling, and in some cases sell all their Chevron and Exxon and whatever stock personally, very publicly. In other cases, they've been activists against the company. But you have this combination of things where you have fund managers who it's not their money, and people that are running giant asset managers, again, where it's not their money, they want a better spot at the, country club or whatever. And so they virtue signal by voting against oil and gas companies and divesting after a multi-year down cycle in a cyclical business, right? So you can always justify, it reminds me a little bit of Einhorn's thing about pioneer resources and natural resources, where he knocked them vociferously for having a negative return on capital, but he knocked them at $30 oil and they spent their money at $100 oil. And so, of course, investments spent at 100 look bad at 30, but it's not fair. You want to look at it on a full cycle basis, not on kind of whatever moment in time you're choosing to measure it. So that's just not intellectually honest. So you have the capital allocators who it's not their money pulling money from investment, both divesting in the secondary market as well as essentially preventing capital formation and pulling their money also from private equity funds. You have the oil and gas private equity funds who have all seen the light and started to invest in the alternative energy space via SPACs and other stuff. And then, which isn't really affecting oil demand and is unlikely to into the foreseeable future. And then you have oil and gas companies, many of whom are choosing to redirect their limited capital away from oil and gas into buying or building wind or solar or other things, which are also not directly competing with oil demand. So I think you're actually understating it by a little bit. I think it's there's even more capital starvation, and it's coinciding with the culmination of a decade plus underinvestment cycle, and so the combination of those is just explosive.
When do you think this hits? Obviously these are shallow decline assets for the most part. There's some shale there, but a lot of this is 10-year lead sort of assets. When do you think this actually starts to matter in terms of the supply side?
So the way that old reservoirs work, well, they vary, right? But many old reservoirs, they are shallow decline until they're not. So if you look at how conventional fields in many cases work, they decline a lot initially, and then in many cases they'll put them on secondary recovery, which is pumping water down to get additional oil out, to get oil that's stuck to a rock or whatever, or stuck in pores out, and then pump in gas or chemicals or whatever, or CO2, to get even more of the oil that's stuck down there out. But what happens is towards the end of your reservoir life, with whichever kind of method you're using to extract, you end up going into kind of terminal decline on your field. And so you saw it with Cantarell. It's why Mexico, despite oil prices being pretty good, and despite having huge reserves, Mexican oil production is down tremendously. And partly they nationalized their fields, partly there are other issues. But one of the big things is just geologically, they're at a point where Cantarell, which was a fairly low decline field, has hit kind of its terminal decline, and it's actually accelerating. So I think, and I need to spend more time, and we've been doing this work, I think some of the fields in Russia are hitting that. And I think that's like one of the problems that they're facing as they try to ramp up production, is that like they're ramping up in one spot, but they're like unintentionally ramping down in another spot or many other spots. And it looks like some of the Saudi fields are getting close to that too. So, it's not, I think it's a little bit more tumultuous under the surface of perceived low declines. And that's where capital starvation, which has happened across most of the oil and gas value chain and across most oil and gas fields around the world, is starting to play out. So in terms of exact timing, I don't know, like it's easy to identify the trend and to say this is a problem. And then you need sustained demand. And so COVID really threw things off. There were giant inventories that built up as demand got temporarily whacked. But as we go into this post-COVID kind of suburbanized, higher structural demand, no one riding subways, fewer people riding subways, fewer people taking buses, more people driving, almost all those people driving using internal combustion engine cars, no inventories for cars at car dealers, used car prices at all-time highs, and all-time low discounts versus new cars. Maybe this is the situation that really highlights how tough the supply side of the equation is.
So you think this is something that is going to last for a while? This isn't something where they could just turn shale back on and fill up the gap?
Yeah. So all of that was about international. Shale, one, there's no money. Two, if there was money, it would have to either come from oil prices and natural gas prices being much higher, or it would have to come from some unidentified source deciding to start funding oil and gas development activities. And private equity was kind of that like last wave, along with alternative lending capital, and both of those got absolutely eviscerated. And so they showed really promising early returns, which got more people to invest, and kind of typical for a capital cycle. The trailing investors that were trying to chase the historical returns, that was the bulk of the capital, and much of it got lost. And so those guys are out. So, money will return to some extent, but you need a lot of money to return, and you need it just to be able to have production stay flat or maybe grow a little bit. But at the same time, there might not actually be enough services capacity. So there's definitely not enough people. So people are getting hired and trained, and it takes a long time to actually end up with the right people running rigs and frac crews. Like they're relatively low paid, but it's a very high risk job, and pay is going up a lot real fast in that area. And it does require a lot of expertise. So you don't have to have a college degree, but you have to be really good at the specific things that people do. But then you also need the right equipment. And we're basically out. One of the drilling rig companies was talking about this. We're basically out of high spec rigs. There's
really?
Not really. Yeah.
How are you out of high spec rigs? There was, there were over 1,000 rigs turning not so long ago.
A lot of them were not high spec, and then a lot of those have been. There's like a useful life for them, and then even ones that are still in their frame of useful life. Some of those during COVID, their parts were cannibalized in order to keep other rigs working. So maybe like super high spec. There are enough horizontal rigs, but like the efficiency difference in between the newest generation or two versus even like one or two generations before that is huge. And so if you look at the incremental production capacity of like a low spec rig versus a high spec rig, there's a almost 2x efficiency difference. But then it's even worse because in many cases, the older rigs require more people, and there's not enough people. And then they require more parts and different parts, and there's not enough of those too. And so, all of that can get solved. There is the manufacturing capacity for that, but that will take a long time. And again, you need capital for it. And it's not clear where that capital comes from as well.
So whenever I talk about oil, everyone just tells me, "Oh, Kuppy, don't worry about it. Shale's going to bounce back, and they're going to add 2 million a year, and they'll basically get back to 13, 14 where they were." So you're basically disagreeing with that view.
Yeah, I mean, strenuously. Like there's just, there is a chance, right? But that's a world where oil is well over 100 and many of the companies that I own are up 10 or 20 or whatever times and are able to now really access capital to grow production. Because right now that market is absolutely closed.
So, I mean, we've talked about oil, but I think what gets less attention really is what's happening in nat gas and especially in the NGLs. I mean, you and I, well, especially you, were early in saying that, NGLs as a percentage of WTI is going to recover. And I remember, we were on conference calls with Antero and, the management team was getting eviscerated by analysts and they just kept saying, give it 6 months, propane's going to come back. And, we all kind of laughed and it did. I mean, how do you see
I think you and I, sorry, go ahead.
No, continue.
Well, I think you and I were both early on Antero and both actually ended up doing really well. I think you did a little better than me, if I recall. But that 70 cent to $4 trade or whatever on Antero was amazing. I don't think either of us really thought that propane would get to such a high percentage of WTI. I think last I checked, it had gotten into the $60 or so range a barrel.
It's stunning. What do you think is driving that? I mean, no one ever thought we'd get above 35.
Yeah. I'm really trying to not make barbecue jokes, but I think the thing that's happened across the NGL space is that worldwide and in the US, there was more processing capacity that was built to turn NGLs into their relevant chemical components or the chemicals that are easy to turn those NGLs into, to crack them, to then be able to use them for plastics or whatever as an alternative to oil, partly driven by the low price for those NGLs versus oil over the last several years. And in some cases, longer than several years. Like, for example, in the Marcellus, there's been an absolute deluge of ethane to the point where there's been ethane rejection for years now. And so various companies like Shell, I think, is just finished a giant ethane processing plant to turn ethane into ethylene, which is useful for various kind of base chemical components to make things. I think you get the elastic bands for face masks and other kind of soft plastics from ethane, and you get kind of harder plastics from propane. So there had been this spread, and capitalism solved this by going and over-investing in chemical processing plants and crackers. And so now you have too much processing capacity, and there has been a lot of plastic demand because of COVID. So COVID has been horrible for the environment as people got scared and started using giant numbers of single-use or few-use face masks and gloves and other medical equipment and other, single-serve food items as everyone orders their food instead of eating at restaurants. And so that's fed into a lot of chemical demand. And then there is this other phenomenon that we've been observing, which is as select chemical prices go down, people that are finishing building their crackers of various NGLs run them anyway. Because if you can run it at a profit, it kind of doesn't matter if it's a 5% profit margin or a 50% profit margin. You just keep running it because you just spent $3 billion or $5 billion or $10 billion on your plant or on your expansion. And so in order to not have to write down that investment right away, you need to show that you are running it. You need to show that you're generating a profit from it. So that's happening at the same time as supply has fallen, as new drilling for shale has declined. And so you have shale production down, shale drilling, especially for liquids rich gas, down a lot. And you have processing capacity up. And it's this perfect storm. So propane's up a lot, ethane's ripping, but it still has a long way to go. And the most interesting part about the whole thing to me is that the producers are not pricing this in at all, from what I can tell. And some of the producers that people hate the most are the ones that produce a lot of ethane or a lot of other NGLs that, people have argued that they're bad because they're low margin, because they've been producing these things that have now flipped from very low price to either already very high price or about to be very high price. And so you have some of the lowest valuation stocks with the biggest moves in cash flow, the biggest moves in margin, and the biggest moves potentially in their share prices to come.
Yeah, and I think part of it, why these equities aren't getting priced in, is people are looking at propane and they're just saying, oh, that'll fix itself in 3 months. And, because every time there's been a spike, it's just been deluged with supply. Do you think it's going to fix itself in 3 months, or is this going to last a full cycle?
I mean, I don't know that propane is going to be at like 65 or something dollars a barrel or wherever it was last I checked. Maybe it'll be at 40 or 45. And like, it's something where it's kind of scary to get that exposure, for me, at least in Antero, where it's already pricing in much higher propane prices, or one might argue that they're pricing it in. I'm more excited about the producers producing some of the lighter end of the NGL basket that are getting credit as if they were still getting $7 a barrel for their ethane instead of the current, I think it's like $14 a barrel, on its way probably to like $20 or $30 a barrel. So, I think that trend is still happening. And so where does it level out? I don't know. Like it's hard to tell exactly, but I think it's similar to like lumber, where lumber got down to $200 and then it went to $1,500 and now it's at like 600 something and seems to be bouncing around there. Like if you're a lumber producer, a sawmill or whatever, you kind of don't need 1,500 to be enormously profitable. You just need it not to be 200. So anywhere in that 600 range is amazing. And so I think there's a similar thing for NGL producers where their margins either have already gotten a lot better or about to. And I think they have the potential for like substantially higher cash flow and then expansion of multiple as they go from low margin to high margin.
Right. I think it's playing out. It's kind of funny. You and I were joking about it a year ago, kind of crying because it wasn't happening. And then here we are, and it's kind of almost surprising that it's happening. It's kind of like with lumber too. Everyone's looking at lumber, which is pulled back by 2/3, and they're saying, see, transitionary inflation. But they're forgetting that lumber is kind of like a double over the 10-year average. And it's a lot of inflation, actually.
Yeah, it's a double over the 10-year average, and it's like a triple or something in the last year. So it's like, okay, well, you don't need it to be up 10x for it to be really, really good if you produce that thing. And 2x is still substantial inflation. It doesn't mean it's transitory, even if it was 5x and now 2x and is pretty stable or inclining. So I agree with you on that.
Yeah, I think we'll see some of these eventually pull back, but at a new higher level. So let's talk about how to make money at this, because in the end, everyone wants to have a play. You and I have debated this a lot. I'm going at this buying 2025 futures and future options on WTI. That's how I'm looking to play this. Futures, the way the curve is set up, which is kind of funny and odd, is that people are looking at the front of the curve as a supply issue. And they're looking at the back of the curve out a few years, and they're saying, don't worry, shale's coming back. Do you think that those guys are right? Or why do you think the curve isn't getting priced better? I mean, I can't be that smart to see that there's going to be an issue.
So the long end of the curve has always been weird. And if you look out more than like a year or 18 months, it's usually not indicative of like true economics. It's indicative of producers' desire to hedge. That's like the very largest supply of those futures past, let's say, a year. And then commodity speculators or consumers' desire to hedge on the other side. And so if you look at what 2025 futures are pricing in, they're pricing in producers being either scared or being forced by their lenders to sell those futures contracts at 50 or 55 or whatever a barrel. And then you're seeing that counterbalanced by, the Southwest Airlines or the Delta or whomever, going and buying those futures to protect themselves against a price spike, along with any speculators that want to bet on oil prices being higher than whatever that futures curve is showing. So I think what you're observing is not, there's narratives, but there's always stories, right? There's like 10 stories for every price move. And 9 of them are usually wrong. Sometimes all 10 of them are wrong. In this case, I think it's just a question of like people's sentiment about that, along with kind of overwhelming number of producers that are hedging versus number of consumers that are buying hedges on the other side.
I think one of the funny things is that these guys are locking in oil 4 years in the future at 50. they're going to have no cash flow, and it doesn't incentivize them to go out there and finance. If oil was 70 out a few years, they could lock it in with futures and get financing. It's almost kind of blocking the capital flow mechanism.
Yeah, I mean, it is ironic, right? It's like a self-fulfilling prophecy. So some of my largest positions are companies that have proportionately smaller hedges, and in many cases have very few or unhedged on their natural gas and NGLs. Ironically, I'm not like super bullish on natural gas from here. $4 an MCF is great. Maybe it goes to $6 for a little bit, but
kind of crazy.
Still, what's that?
It's kind of crazy in terms of cash flow and just gross margin received by the producers.
Yeah. I mean, there are some producers that we've talked about where they might have like $1 or $2 or something like operating lifting costs, including their royalties, and so for most of the last 5 years, their gas has been basically considered worthless. The assets have been considered nearly worthless. The fields, like the undeveloped locations, have been considered worthless, and at strip pricing, their fields are worth enormous fortunes. And so I think one of the things that gets me excited about owning the producers, and again, I understand the whole ESG trend, I understand the regulatory risk and the tax risk. I'm staying out of certain jurisdictions, but obviously to the extent that these things are federal, this could hurt this thesis to some extent. The flip side is, I think as OPEC plus disappoints and shows that they have less spare capacity, and as some of the terminal declines start to kick in across the kind of non-OPEC international fields, as well as shale shows that it can't grow at 2 million barrels a day a year anymore, and maybe it grows 500,000 barrels a day in a year, maybe even 750,000, but doesn't grow 2 million. And then as that growth happens, services costs spike and the whole thing becomes a mess. I think that production becomes worth way more. And so if you look at it on a multiple basis, if you're right about oil, and if oil is 80 or 100 or something 5 years from now, a producer that's currently valued at 2 times cash flow might be valued at 6 or 7 times cash flow, but their cash flow number is much higher. Their share count is down a lot. Their debt has been repaid. Maybe they're paying a big dividend. Maybe they're actively repurchasing 10 or 20 or 30% of their shares annually. So I think there's room for that sort of repricing. And I think the benefit of owning the producers is I don't have to pick an exact date for that to happen. And as long as my companies are still there, and I do a lot of careful balance sheet analysis and cash flow analysis to make sure that, generally speaking, the companies I'm invested in aren't going bankrupt, I think there's this benefit. And then there's the added benefit. It's like real hard to make this same bet on like ethane. And so I guess you kind of can, but like it's a very thin market a few years out. And so some of these companies are making extra money while I wait for this kind of bigger oil bull thesis to play out. And so I get paid now through some of these NGL and natural gas and other sort of like local realized price bets happening. And I have the same sort of upside, maybe even more upside to a future oil price move. And again, I think you have to be selective. I think owning the index for this sort of trade, I think you're better off doing what you're doing than if you owned like XOP or XLE or something like that. But I think there are a set of producers that should way outperform even versus a long oil call bet on oil futures.
Well, I guess in 4 years we'll find out who got that right. Do you want to give a few tickers, just quick overview of 2 or 3 of your favorites? Everyone knows where I stand. I just own the 25 calls.
Yeah, sure. So I'll name a couple. So one is Sandridge, which we've talked a lot about. I know you may own, you definitely owned in the past and have talked about.
I still own.
And they're one of the biggest beneficiaries of this kind of like the lighter end of the NGL barrel range. And, they're at like 2 times cash flow or something like that. They're sitting on $1 billion infrastructure asset at replacement cost, which could be useful for oil or other stuff, depending on what they end up using it for. But, I think it's something like 1,000 miles of pipeline or something, gathering system. At 2 times cash flow for fields that actually are pretty low decline at this point and used to be very low margin, but at higher gas like we're seeing and at higher NGLs like we're seeing, I mean, these fields are actually pretty decent margin and they're getting a lot better. And so, I think something like Sandridge could end up re-rating to a higher multiple to reward the lower decline rate and the kind of more, this is going to sound weird, but like Mississippi lime is like unpredictably predictable. Like it's kind of, you know what you're dealing with. It's terrible, but it's like also consistently terrible. Um, that sort of asset could get, let's say, 5 times instead of 2 times. And, you know, as they hopefully repurchase shares, pay a dividend, whatever, there's the potential for return, for a return that, you know, hits your kind of 10, 15 type X versus the futures.
That's crazy. I mean, you had told me you thought that they could actually drill economically at these this price curve. You still stand by that?
Like, it's getting close to that. I don't know. I haven't seen an economic Mississippi lime well in a very long time, and maybe there haven't really been many that have been drilled. But it's getting close to that. If ethane prices continue on their current trajectory, and if service costs stay relatively low, I think there could be, especially on pads that are already built. So you're really only talking about like kind of quarter cycle type economics. I could see. Everything's already built. You're just coming in, drilling a well next to existing producers with disposal already set up and everything. Yeah, I think at $4 gas and with ethane where it's at and oil where it's at, you probably actually make some money drilling, which is wild. I mean, these guys are sitting on, I think, like 300 plus booked locations, and there's probably like 1,000 or several thousand that you could actually drill on their land. You know, if gas was even higher, NGLs were even higher, and so. You get like a huge amount of inventory for free, and you get this bet on NGLs, and you have a balance sheet where I think they have substantial net cash, and so seems pretty safe and relatively speaking, and has some of that same upside that you're looking for on the future side.
Oh well, I'm long also. Give us one more name. Like, what else do you really like?
Sure. So I really like Baytex. It is something I've like written up somewhat recently. They have a big oil discovery in Canada in the Clearwater oil formation. And so I know I just talked a lot about how there hasn't been a lot of drilling and there hasn't been a lot of exploration. In Canada, there are still some small fields like the Clearwater where you can get an additional like 50 to maybe 100,000 barrels a day of oil total in aggregate across that field. So that's great for these producers, but very small in terms of the world supply demand balance. So this sort of thing like doesn't really move the needle worldwide, but it moves the needle hugely for Baytex. They're materially cheaper than many of their competitors because they had an over-levered balance sheet. Even at $50 or $55 oil, they're pretty good as they rapidly pay down their balance sheet or pay down their debt. And they have this giant discovery. They have signaled publicly through their CEO going and doing this big like ceremony that their next wells on the area look good too. And they have basically embedded a self-funded additional 10 to 20,000 barrel a day field in their Clearwater, which they're getting zero credit for. So at like $50 or $55 oil, they're probably worth 2-ish times, maybe 3 times what they're trading for. And if you end up right on, oil being mispriced a few years out and maybe it's 100 instead of 50, similar sort of thing where this could pretty easily be a 10 or 15x. And, these guys, unlike most of their competitors, they grew organically. So they actually found this field. They negotiated with the owners of the mineral rights, which in this case was a First Nations tribe. And they have a great relationship with them. They're able to get the field without by committing capital spending, not committing any sort of like billion-dollar purchase of land or anything like that. And so, I think that sort of ingenuity and that carefulness in terms of not diluting substantially in order to get additional resource, I think that ends up getting them a premium multiple as that field ramps up. So cheap stock, decent amount of financial leverage too, which SandRidge doesn't have, but they also don't have the same sort of torque in terms of like an ethane or other sort of recovery. So as oil goes up, to the extent that you're right, this thing could end up as a 10 bagger or more. To the extent that you're wrong, I'm wrong on oil, it could still end up being a 2 or 3 times return as they go and develop this asset, even in a lower oil price environment.
Sounds like good odds. So I guess you've done a lot of research. I enjoy your white papers. Where can people find more information and sign up to get your white papers?
Sure. So bisoninterests.com is our website, and people can sign up and can see our content and can sign up for emails from us. And then Also, we put out stuff on, I write stuff sometimes on Seeking Alpha, and we're also pretty active on Twitter at Bison Interests.
Great. And, I've been consuming your content for a while. It's great stuff. You're always early on these trends.
Yeah, and it's free.
Yeah, but unlike a lot of free content that you get what you pay for, this actually has value.
Yeah, I think the game is just to share kind of what we're seeing generally, and it's nice to be able to be one of the value added content providers in oil and gas are pretty slim, and so it's nice to be able to share what we're seeing, and we do it partly because it helps us find alignment with our investors, and then also because we've been very lucky, including with you, to be able to get some great individual investment ideas through sharing our research and debating what we're seeing. So we appreciate it, and I appreciate it.
Yeah, and once again, I think people should go check it out because there's some great content there. Hey, I really do appreciate you coming on. It's been fun to do this, actually. It's the first person I've ever interviewed on a podcast. So obviously want to interview one of my good friends, and really do appreciate you coming on. So for everyone, this is Josh Young from Bison Interests. Thank you.
Okay, Patrick, time for Talking Charts. What do you have for us?
All right. So please note, everyone, that we are, it is Wednesday, July 28th at the moment when we're recording this. So the charts will be a few days stale when you're watching this. But let's jump right into it, Kevin. Talk about the three things we were watching this week. The first thing we were watching is whether the trend in the momentum factor continues. And we only had a few days of data since we actually covered it over the weekend. And so really, it's been really flat. There just hasn't been a shift, but the trend still remains intact. Facebook had its earnings and Apple did, and both have actually, as of this moment, weakened from their prices, even though they were announced earnings beats. And so it'll be interesting to see whether this stalls out the FANG stocks or not, and which could influence this. But right now, that trend remains intact. So number two, we were talking about the FOMC. How did that come out for you?
Well, geez. I thought he was going to be a little hawkish, and he was anything but. We have a big move lower in real yields and break-evens exploding higher. It looks like he managed to figure out how to be even more dovish.
Well, there you go. And number one thing we were watching was the commodity index as to whether it was destined to break out to 52-week highs. And well, Kev, it did. Right? Like, what's interesting is that so oil hasn't made a new high from its earlier June, July highs. And things like copper are still under, and the grains have pulled back, and lumber is down. But things like iron ore and some of the other periphery commodities, steel and other things, are doing pretty well. But it is interesting that this commodity index is just plugging away on the upside, irrespective of the fact that there are so many underpinning commodities that are not breaking 52-week highs with it.
It's kind of shocking because everywhere you look, people are negative, thinking that the economy's rolling over, all sorts of reasons. And meanwhile, the commodity index chugging to new highs. Yeah, and Patrick, just as an aside, I like watching the industrial raw commodities, which I don't know if you can pull it up on.
No, I can't.
You can't. But that's one that has the commodities that are non-traded, or not all of them are non-traded, but more of them are non-traded. There's like tallow and what are there? There's some really weird ones.
Is that one also going 52-week highs?
Yeah, and that one hit a new high as well. That one's part of my favorite indicator, which is the Ed Yardeni magical indicator. I don't know what he calls it. The S&P fundamental indicator, he calls it. And those two have diverged wildly since the COVID, and it'll be interesting to see if we're going to get kind of convergence by commodities ripping higher.
I'm going to stick my neck out though on this. And I'm gonna. Okay. This is the crude oil chart, and crude oil for the last 5 days has done nothing. And while I won't rule out the possibility that we break to 75, retest the highs, and head to 80, 85, I'm not trying to be outright bearish. But if crude oil, for whatever reason, rolled over here without breaking to new highs, then I think it's a prairie dog. Like the crude oil is just such an important component to that index. I don't understand how that index would go on a new.
Oh, you think
bull
it's a
run.
prairie dog on the commodity index?
Exactly on the
Okay, I was
commodity
going to
index.
say that does not look like prairie dog formation.
No, on the commodity index breaking,
Okay.
it just broke to new highs. But
Well, listen,
like,
the last time I called it prairie dog was in the stock market, and it seems to be dead wrong. So I don't know if we're just seeing too many prairie dogs. 'Cause it's
There's
summer
prairie
or
dogs
whatever.
everywhere, man.
Yeah,
It's like look right and left everywhere. But no,
Yeah.
it's whatever we want to see, right? Anyway, so now I want to move on to what we are going to be watching next week, but we are going with a little bit of a different format. So Kev, we haven't revealed to our listeners is that we're pre-recording a number of summer specials for the Market Huddle that will run throughout the month of August.
Right. So don't worry, they're still going to be there. They just won't be live.
They won't be
Meaning
live.
that we won't have content that we're updating every week. So we won't be commenting about the markets, but there will be all sorts of content.
So great interviews and all sorts of great stuff.
We got some real gems. We have a couple that might surprise some people.
That's right. And so what I want to do is rather than doing things to watch next week, we decided we're going to do the things we're going to watch for the rest of the summer. And so let's go through the top 3 things to watch for the rest of the summer. And we had to pick some bigger picture things. And the number 3 thing that I was for sure wanting to watch was the shift in whether the shift in the equity market trends occurs. Particularly, we've been beating like a dead horse this trend that has been occurring in the equity markets where the FANGs are outperforming, breadth is deteriorating, and we have a lack of participation in these other sectors. This can only last so long. At some point, either the rest of the equity markets are going to start participating in a proper bull run, or we're going to end up seeing that the FANGs give out and start correcting, and then maybe it triggers some sort of a bigger correction. And so I think one of the bigger things to watch, especially now that earnings are starting to come out, it's interesting, like right now, at the time when we're recording, Facebook just came out with its earnings with a beat, but it was closing at 52-week highs at $373. In the after hours right now, it's down to $359. So I have no idea what it will be opening Thursday morning, but it's starting on the down. And you take a stock like Apple that reported it failed to break the 52-week highs on its earnings. It started a little bit of selling. So the question is, can the FANGs continue their momentum? And can the FANGs carry the weight, or will we see the breadth widen in this market? And what's interesting is that typically and historically, the month of August, September, and October have housed a disproportionately large amount of market corrections. And by no means does that guarantee one is going to occur. But certainly, if we see, let's say, the FANGs roll over and the rest of the markets don't participate, maybe that's enough of a deterioration in conditions to trigger some sort of a mean reverting correction from what's been a pretty solid run in the broader markets. What's your take on that?
Well, I was just laughing, Patrick, when you said, well, either we're going to get the FANGs roll over and join the rest of the market lower, or we're going to get the rest of the market expand and join the FANGs higher. And I thought to myself, whenever you do that and you tempt the market gods, you know what's going to happen.
The opposite.
Well, it's going to be that we're just going to get more of the same. And wouldn't that just be the ultimate pain trade? Can you imagine if we just got a
No, actually, I don't think it would, because I think most people are in pain right now. I think if the FANGs started to correct, but the rest of the market turned up as, let's say, a reflation trade kicked back in or something like that, I actually think people will be in much better shape.
Yeah, but I'm saying that the worst pain trade would be having FANGs continue ripping higher with the rest of the market just, sucking wind.
Absolutely. So
that's
if you want to bet on
yeah.
the pain trade, then you just have to bet that the continued trend persists.
Continues, right? Because the reality is that the reason this is happening is because most people had sold too much tech versus going into all the other reflation trades.
Yeah.
And when that trade stalled, everyone rushed back to tech. So I'm not predicting that. And
what
I don't
is
think
interesting,
that's
and
the
a
case.
part of that rotation as well, has been a material outperformance of U.S. equity over that of global developed markets,
Oh,
including
100%.
emerging
It's
market.
Just screaming higher.
Right, versus so let's just quickly use this opportunity to punch through it. Nikkei trading sideways to down through this period. The Euro stock not able to break to a new high, but it is a better trend and it's holding up higher than most. But the emerging markets using the EEM broke to a lower low. The Sensex trading sideways for 2 months. China just getting its face ripped off on the downside. Big reversal day today, but still up 5%. But it's just getting hammered to down. I don't have the chart here on Shanghai, but that was also breaking down on the downside. Point is that if you weren't in U.S. equity, you ain't got any performance for the last 3 months. And it's
not only that, Patrick, go pull up the Russell.
Well, yeah, and that's
because you're saying that if you weren't in U.S. equities, then you don't have any performance.
No, but it's
the reality is if you didn't have the right U.S. equities, which was the top 5 tech names, you also
basically the Russell is flat since February. Yeah. So you had one little surge in January that was up, and basically the Russell is flat on the year.
Yeah,
and so really,
it's 5 stocks. It's 5 stocks driving the whole index.
Well, you know what? I don't know because, those healthcare stocks have been running. There's a
more.
few, but there's the big market cap behemoths that are driving the momentum.
Wouldn't it be something if they just kept screaming higher and just astounded everybody?
Well, you know what?
What if we had Apple tacking on $100?
Okay, well, isn't that interesting though that they did? You know where I would have started to drink your Kool-Aid?
I'm not saying that. I don't think that should happen.
You're just saying what if, but I would have believed you more, or at least subscribed to that idea if they actually popped on their earnings. If let's say right now on Apple and Facebook, both of them just went 5% higher in the post earnings period and really triggered almost a FOMO to chase them higher, I'd drink your Kool-Aid. But right now, the fact that there's positive earnings and the stock sold on that makes me at least put a question mark there as to
I'm not listening. It's a low probability event. All I'm saying is the market has a way of messing up, causing the most amount of pain, and I'm just pointing that out. I don't think it's going to happen, but it would be something, and it would make for quite a summer, and that would really cause the most amount of pain, and people would just be, dumbfounded. And listen, now that we mentioned it, there's no way it's going to happen.
But you know what would cause even further pain to people with that?
What?
Let's talk about credit markets because, boy, anyone that would be long break-evens would continue to get squeezed a little bit, wouldn't you think?
Well, no, because that's interesting, Patrick, because if you look at today, you would think that you would look at it, you would go, oh, the bond market was up on Powell, he was really dovish, therefore break-evens are going to be going down. And they weren't. They were up. Even though bonds were up, what was up even more were tips. And that was the real move. And the real surprise today was the fact that the tips and real yields blew out to new all-time lows. I'm looking at the 10-year tip yield. It's minus 1.18%. New low, new record low.
Isn't it interesting that someone hasn't lit a match under gold yet under those circumstances?
Yeah. Well, so that's what I did today. I bought, some precious metals because given that we have real yields trading down here and I'm not going to chase NASDAQ. That's not my style.
Yeah.
And maybe I'm showing my boomer age.
Yeah, you are for sure.
Yeah, that's right. You and I are both
because gold isn't moving, but the
real yields.
Asset the asset that should not be named has been moving.
Oh, it's been flying.
Yeah.
Well, because that's the real value.
See, this is the problem. You're a boomer.
Yeah, that's the real value. That's the reason that, because that's where the real kind of value lies. So why would gold move? Stupid rock. When you have these bits in the sky, obviously that's the thing you should move.
Anyways,
back to the real yields and the gold. I think it is a great trade. That is something to think about. And one thing that I'd like to stress, Patrick, is that if somebody says, "I know how this is going to work," take it with a huge grain of salt because we are in an environment that we've never experienced before. This is truly unprecedented times. We have inflation running well above 2%. Yet we have the Fed buying, whatever they're buying every month, 100 billion or whatever the number is, I've forgotten. Not only that, we have the TGA depleting, and there's so much liquidity in the system that the Fed has to go out on the other side and sop it up. So there's so much liquidity in the system, the Fed is trying to sop it up to reverse repos. Yet at the same time, they're adding more liquidity. They're pushing and pulling. It's absolutely crazy. And to know how this is going to all work out is you're using a precision that doesn't exist. And no matter who you are, you can take your best guess, but nobody really knows because it's been a long time since we've done anything like this.
So real yields are down, but what is interesting is that when you go to like obviously the 10 and 30-year yields are pressing lower, but that doesn't. We continue to see the bull flattener still in trend, right? But obviously, the front of the curve is the most pinned, and so it's either really a factor of the bear steepener or the bull flattener in play. But this still is bleeding out. The 210s trending lower. The 530s don't look like they have a pulse off the bottom. This continues to deteriorate.
Yeah, I'm not going to deny.
Right.
And I don't, Patrick, I think you had a great point. Was it last show where you said, look at the global credit markets.
Yeah.
Look at what's happening. Yields are going lower.
Oh,
everywhere.
Let's do that. Look at what's happening. Like this is the yield in Germany on the German Bunds. We're going from they hit their peak at minus 10 basis points, and we're right.
That was such a great yield. Get it while you can.
Get it while you can. As close as possible to zero.
I'm only going to lose 10 basis points a year. This is unbelievable.
And so what you can see here, though, that with this downtrend in play, they're heading right back down to 2020 lows.
Yeah, it's a complicated interchange of a lot of different things happening, meaning that we have liquidity, we have changes in portfolio composition with different managers, and then, as I said, we have banks or central banks buying and selling. It's a crazy time, and just be careful because everyone's assuming, they're running out and buying S&P 500 hedges, and maybe that works, but it almost feels to me that we should be more scared about the right tail hedges than the left tail.
Oh,
now, I probably just caused a crash this August.
Yeah,
listen. When we crash in August and have a flash crash and the S&P is down 30%, make sure you guys take a little snippet of this and say Kev caused it when he said that.
I'm a left tail still.
Yeah.
You know
listen,
what? Look, I'll drink. No, listen. No. I'll drink your you and Kuppy's little Project Zimbabwe Kool-Aid at some stage, but I don't think this is it. I don't think that this is the moment where they've gone too far and that things are just about to go ripping. I think that it's always a risk, and it's certainly something that has to always be entertained as a risk. I just don't think this is the environment that's going to happen. Anyway, what I wanted to just touch on here is might as well touch on these credit spreads on these junk bonds, right? And we did have that spike from 3% towards 3.5%. It'd be interesting to see whether junk bonds are finally turning here, and that's something that I think that's worth continuing to watch.
Yeah. So this was my idea, Patrick, when you asked me what to watch in August, and I thought about it, and I thought, if we're going to get a correction in the stock market, often the bond market sniffs it out first. And there's obviously a lot of attention this week with the Evergrande, Evergrande, I don't know how to say it, the big Chinese property developer. That's a very large issuer of bonds that have gone in half. They've been cut in half. And yet the bond market, just like the credit market, meaning the corporate credit market, seems to be taking it in stride, and there's no issues at all. And if we are to see some problems, when I'm thinking about things to watch that might give you a clue that something has changed, I think that right up there will be corporate credit spreads. And that is something you should be keeping your eyes glued, because it is very difficult to get a large sell-off when corporate credit is so well bid.
Right.
Like, can you put up the spreads? Can we see the OAS spread?
On the high grade?
Yeah, just pick whatever. They're all tight.
Well, this is that was the junk that we were looking at.
Right, but that was the absolute yield, was it not?
No, that was the credit spread.
Oh, that was the credit spread. Okay. Oh, yeah.
So,
I see what you've done there. You've clicked on option adjusted spread. I got it. So there you go. So there's investment grade, and I think that 75 tick was a low that we haven't seen since 2004.
Yeah.
So not only have we got real yields at just
but you have to put into context.
Lows.
You have to put in context though how low Treasury bond yields are, because I mean, they're all the spread is narrowed, but the yields on the whole bond market have generally gravitated lower. So it's much easier for spreads to be tighter when you have such low yields, right? And so comparing it to 2004,
I don't know if I buy that argument, because in absolute terms, the corporate might say, "Oh, I don't care that I'm paying a wider spread because." The reality is that the total number, the nominal number, is lower.
Yeah.
So I'm not sure I agree with that analysis. I get what you're saying though. Like in 2004, rates were 5 or whatever they are.
And now they're at 1, right?
Yeah. Okay. Anyways, I do believe that it's something to watch. The credit market is often much smarter than the equity market. And if we are to get a sell-off in the equity market, I think that you'll see, or at least a serious sell-off, I think you'll see some signs of it in the corporate market first.
Yeah. All right. So number one thing to watch over the summer, is going to be Jackson Hole. So what do you think is going to play out there?
Well, so Jackson Hole, I believe, will be the Fed trying to stick handle and get the market prepared for the taper. And the question is, is everyone already ready for it? And will it be kind of a non-event because the Fed has given us so much notice? That's increasingly looking like what it's like. But having said that's most likely when we're going to get the official announcement, or at least a guide in terms of how the official announcement will go. I was of the opinion that they were going to taper, or at least be more hawkish on the taper than I thought. I thought when I look at it, if I'm the Federal Reserve and I'm thinking about what the taper is accomplishing, what the QE is accomplishing, I don't think it's helping the average Joe very much. But they obviously live in a very different world, and they think that it is, so they're continuing to do it. But the long and short of it is the market is preparing for a Jackson Hole taper, so that's probably the number one thing you should watch.
Perfect. All right. So what I wanted to do is maybe just look at a few more charts that we didn't get to, because we did cover a lot of them here. So we don't have to spend too much more time. But I wanted to start off with just the currency, because you know how I think about the U.S. dollar, right?
Yeah.
But
you've been very good. You haven't tried to put it in the top 10 list or the top 3 list for a while. We need a top 10 list.
Because I've been shamed. I've been shamed into submission.
You can get it in there every week.
So the euro US dollar has come to a support line. I thought it could have gone all the way down to 117, but if you put on any indicators that are measuring divergent momentum, it really started to slow its selling on the way down in the final last month. Really, month of June was where all the violent US dollar rise and euro drop was occurring. So with the reversal here on the FOMC came this green candle, and obviously by the time members are listening to us, they got the benefit of 2 more days of information here. But in such an oversold state, it is typical for there to be a reflexive snapback rally. Think of anything even like these 3 candles right over here, or let's say these 3 candles right over here. What happens is that once a selling ensues, there's typically a reflexive snap the other way, just to kind of mean revert the prior trend. A move on the euro back to 119 or 120 would actually be quite typical for us to occur. But what will be interesting to see, will we get that reflexive snap? And is it just that? And that the US dollar will resume higher and the euro will head right back to 117, 116. I think that's a pretty important thing to watch over the summer. This is not going to be just a 1 week thing. And so where and how far will a bounce on this go? And subsequently, will the U.S. dollar continue its trend higher once it kind of retraces this little bounce? You have any opinions on it before we go on?
No, I like it that you're not telling me the U.S. dollar is headed straight up, though.
Right. Okay. So where it will? No, just kidding. But let's go to the U.S. dollar yen, where it will. No, just put it. What it is interesting to see that overall the U.S. dollar has been holding up. I mean, that move in the U.S. dollar against the yen at the start of the year was just one doozy of a move. Now, what is interesting is that the upside momentum has massively diverged. So use just this momentum of this first move, and then look at the slope of this rise, right? The overall velocity on the upside is completely curtailed. And what will be really interesting is if the U.S. dollar against the yen does take another stab to the upside over the summer, but doesn't really make much of a higher high or doesn't gain any traction to the upside, is that going to start to indicate that there's a bigger topping formation developing in here? I think at this juncture, it's up to the bulls to really grab this by the horns and just run with it if they're going to keep this going. Because if they have failed rallies here and momentum shifts, then it may start to be the first signs that the U.S. dollar rally that's been working all year may be running out of momentum.
I'll take the other side of your analysis. I'll say that yen trades to a beat of its own drum.
Okay.
And that the U.S. dollar could go down and the yen could do the exact opposite.
You're talking about the index.
Yes.
Yeah. But I'm talking about this the momentum of this chart. I'm not talking.
So I hear you, but I'm just I guess what I push back on is I think we could get a situation where euro is up and this yen chart, which will mean yen strength, is the other way.
Could also go up.
Yeah.
Yeah, it's possible. And I'm not opposed to that. So now when we talk about the asset that shall not be named, what a reversal this thing had in the last 4 or 5 days on the upside. Of course, we're talking Bitcoin for those of our listeners that can't see the chart. But one of the interesting things when you have this kind of, this was such weak distributive price action for over 2 months on the downside. With this type of velocity on the upside, this is going to be a really interesting moment on the crypto because even just a day or two ago on Monday, there was an attempt to reverse it back on the downside, and the bulls just came right back in and took it higher. This is the first constructive price action that we have seen all year. Like you have to pretty much go back to like January to get anything that remotely was bullish. And so what will be really interesting here is that when we do inevitably get a little bit of a sell-off, will the bulls continue to buy dips? And will we see that they shift the momentum of this? And I'm not going to have you comments. We're just going to go on.
Oh, no.
So no. I don't want to hear your opinion.
Okay,
Let's.
Fair enough. I'll keep my mouth shut.
I'm just trying to save you from yourself. So crude oil, like we were talking about, that commodity index is going to be really interesting to me. And the commodity index broke to higher highs. Crude oil hasn't really, all week, it's been pinned to $72, give or take, 50 cents. And what's interesting is that there isn't too many points in the charts where you can identify where oil just was dull. You have to go back to January where it kind of traded sideways for 2 weeks right here in this pocket to see this type of a consolidation in oil like we're seeing right here. The question is, this is not normal. At some point, oil will trend again, and I think it's going to be a huge tell this summer which way it finally breaks. I mean, if we start punch back to 75, there are measured moves going to 80, 85 on the upside, and suddenly, if the oil bull renews, these energy stocks are so oversold. Like look at something like the XOP or something like these energy, or let's say even the refiners with the crack ETF, just they got murdered, right? From 31 down to 26. You take the OIH, which is the oil service stocks, from it went from 250 down to 180. This entire space was just murdered. And what would be interesting is if oil broke to the upside out of this little trade range and really started to look like it was going to make that punch toward 80. Is this a big buy on dip on these energy stocks? That's a big question that I'm watching. Like, I don't want to already make the call that this is the case, but I think our listeners can be watching this because maybe if this starts to play out, there might be an opportunity to jump onto the coattails and go for a ride for a trend move that may emerge. Alternatively, I think that if crude oil doesn't manage to make that break higher and rolls over, then that's going to drag that commodity index back down, and it's going to be one big prairie dog. And I can't think of something more important to watch this going into the summer than the back half of the summer than watching this. I think it's going to be really important which way it breaks.
Okay. All I could think about was when you kept talking about the murders that we have to call Angela Lansbury. It's a boomer joke. And people don't get it.
No, they won't. They won't get it.
Actually, have you ever thought about for those who don't know, Angela Lansbury had this show. It was called Murder, She Wrote. And every week she would go to like a dinner party or something and someone would get murdered and then she'd solve it. And it's very obvious that she was killing the people and then framing someone.
It was?
Well, yeah, because like how often are you around a murder? She was around a murder every week.
You know what? You're onto something.
Yeah, well, I can't believe you just figured this out. Let's get Lena on just quickly. I know she doesn't usually come on for talking charts.
Yes.
Did you watch? Are you too young for Murder, She Wrote?
No, I'm not.
Yeah,
actually.
right. And so
I remember watching them. I think maybe I was too young to understand exactly.
Yeah,
what
you
was
were too
going
young
on.
to realize that she's killing them. And then,
Is that what it? Now I have to go back and watch.
Well,
them
think
all.
about it,
Lena.
Literally
don't
every week
listen to
somebody
him.
would die.
Do not listen to him. Kevin thinks he's funny. This is very amusing to him, and like
Don't encourage him. Okay, let's go on. Sorry, Lena. We'll let Patrick do his little talking charts.
Anyway, similarly if you just jump over to copper, what a really nice, clean, strong breakout copper had this week. And one of the things that I always look for on a breakout like this is can the bulls defend all little corrections? So now we started this week with a quick little profit taking cycle from 460 back down to under 450. This level, give or take, 445 to 450. If this level, if the buy and dip traders come in here and buy the dip and roll this back up, maybe copper is ready to go for another uptrend. Watching whether or not the bulls can defend this. The most disappointing thing that could happen to this chart is that the profit taking sellers hammered all the way back to 4.25. Now I'm not predicting that, but right now this is up for the bulls to prove that they've started a new trend move.
Okay,
Nope.
I got no comment. I got nothing on that.
Then let's just leave it at looking at the Eiffel Tower formation on lumber.
Lumber.
And you know what? I am shocked that this is the best the bulls could do in terms of a reactionary bounce before they hammered it all over again. Now, this doesn't seem like a lot for people that are analyzing this, but on a percentage basis, this is crazy swings, right? Like, let me just zoom in on this, but like just the selling of the last 3-4 days from top to bottom was a 23% wipeout.
Yeah, it's because the volatility was so huge before.
Oh, it is. But, like, you would think that even just like in the middle of June, this was at $920. You would think that they can muster up a reaction back to 750, 800 on the upside. No, the thing rallies for 3 days towards 700, and boom, the sellers just hammer it and wipe it right back down to the mid 500s. To me, that's still very distributive, very weak. Lumber just doesn't seem. It seems like this is dead now.
Oh, I like to hear that.
Anywho, this is where we'll leave it for talking charts. Let's move on. I think it's time for us to just settle a quick bet.
Yeah, the skin in the game. I lost again. I am so ice cold. It's not even funny.
But this is the best part. Is that all I have to do is just make the most neutral bet possible and let you fall on your own sword.
Yeah, well, you know what? I forgotten that it was going to be early
a short
settlement.
week. Oh, come on! And that it was. I literally gave you the over under at the money. Like you could have picked any direction. 3 days, 5 days, it wouldn't have changed anything.
Yeah, well, no, but if it's going to sell off tomorrow, and anyways, doesn't matter. I lost again. And so now you get to string me up and do it. Oh, we're not doing one.
We're not doing one, but what we will do. So again, we're going to resume all of this back back around Labor Day. So when we come back, I'm going to be the one to make the opening bet. When we fire this up again. But right now, luckily, all the listeners can enjoy the extra pitcher of beer on Kevin's tab that's been added
for the piss up.
For the piss up, yeah.
Which is looking good. Once you're back from your moose hunting? You guys think I'm kidding, by the way. I'm not kidding.
All right, save that for the after show. All right, so let's move on though to no stupid questions here, Kevin. Well, actually, let's get Lena on. Hey, Lena, how's it going?
Good. How are you?
Very good. So why don't you hit us up with the first question of the week?
All right. So the first question. Hi, Patrick, Kevin, and Lena. Great show recently. Love the banter. Patrick mentioned something this past episode that I had been noticing myself, which is that the market seems confused. I am largely a natural resource and commodity investor, but have been expanding my horizons and diving deep into macro, bonds, currencies, trading as opposed to investing, and everything else the markets entail. I managed to exit most of my commodity trades in early June before they all took some big hits, scalped some bond trades, and now I'm largely sitting in cash. I feel the markets have been confused since mid-May, early June, and I'm wondering what signs to look for that the market has picked a direction. In my opinion, it is not clear that the growth trade is on, and it's not clear that the value or commodity trade is over yet. Even the bond market seems confused. Do you look at ratios for IWF versus IWD, which is approaching resistance, for example, or is it more about bonds or maybe the Fed? I don't mind holding cash, but it's been a few weeks now, and the FOMO is kicking in. Thinking about where we go from here is a real head-scratcher. P.S. Did you know Letterkenny was filmed in the good old home of the Big Nickel? Nice win there on the steak dinner, Pat. No more kids' table with those big boy moves.
There you go.
I did know it was filmed in Sudbury. For those who don't know, the Big Nickel is Sudbury, the home of, was it Inco? Was Inco or Alcan? No, it must be Inco because Alcan's aluminum. Inco, and if you're ever in the wonderful town of Sudbury, they actually have a huge nickel that's that's a statue, and it's a time-honored tradition in our household to take the kids and to get one of those pictures where you pretend like you're holding it. You know, you use the right angle. So make sure you do that. It's kind of something you have to do.
There you go.
Okay, so let's answer the market question. Do you want to take this one or me?
I think both of us. The one thing that I want to comment, like I feel that the confusion is maybe to me is not as much in the macro as the confusion is more in the equity markets. Like with the fact that the breadth is deteriorated, that's where I'm finding a lot of the confusing signals. I feel that in the bigger macro space, that the reflation trade ran just too hot and it need to mean revert. And I don't think that changes the bigger trend. We could still be in the midst of a big commodity bull market. We could still have so many of those major trends resume. But almost the one true thing about the stock markets is that every rally that goes too far will always mean revert and correct. The things like these commodities have had an extraordinary run for 6+ months since November, and they were due for some mean reverting corrections, and we're getting them. I still think that they're going to be probably great buying opportunities, and so I don't think that in the macro space is as much confusion to me as much as it is what's in the equity market. But what's your take on it?
Well, I guess I kind of agree, but with a slightly different nuance. I think the reason for a lot of confusion is that from a fundamental basis, not much changed over the past couple of months, yet there has been outsized corrections in all of these trends. So, and I will agree with you that once, when trends run...
They had extraordinary freaking runs
right.
that probably were way over.
What I'm trying to explain is the reason that there appears to be confusion is that the correction amounts on these trades don't seem appropriate given how much fundamentals have changed. And I guess that's where it comes from, the confusion. And then not only that, Patrick,
corrections are meant to wash people out and cause pain.
And listen, I'm not disagreeing with you. I'm just trying to explain the confusion, Patrick. I'm just trying to explain the confusion. Then the other thing that in terms of when I read or listen to his comment, one of the things that I would stress is this is summer. Be careful in the summer. Strange things happen that I would say are not... don't give proper signals. It doesn't take much to move markets. People can jerk things around. There's not the big liquidity that would usually be there. And August will be even worse. So he sits there and says, I don't like being in cash. Listen, given that everyone except the hardcore deflationist / kind of end of the worlders, everyone else has had a tough last couple, month or two. And so the reality is that being in cash and just not getting hurt as this stuff whips around and it figures out and becomes kind of settles down, there's nothing wrong with that. There's nothing wrong with being, a little more to the sidelines. You don't need to always have a position.
Right. I mean, where I will just push back a little bit in there is that sometimes you don't want to overthink the market timing. Some of these stocks, okay, like let's just take Freeport McMoran or something like this, right? Freeport McMoran hit a high of $45. I mean, during a 2-month market correction, the thing wiped out to like $31. It was a solid 30+% correction in the Freeport McMoran stock on a copper bull narrative that's out there. Now, can Freeport McMoran...
Okay, well, I got to stop you because I think you're saying it wrong, which is no surprise, but I think you've now messed me up. I'm not going to be able to say it. It's Freeport McMoran.
Like McMoran. Thank you. McMoran. Okay, thank you, Ray. Okay, so McMoran. Thank you, Kevin.
I might be wrong as well.
So no, you are right. Anyway, so
it sounded like you were saying Freeport McMoran. Actually, you were saying that. Now that the McMoran.
The McMoran.
Patrick McMoran Ceresna.
Oh my God.
Keep going.
So, okay. So the point is, the stock wipes out down to the downside 30+%. Now, can that stock at some point be down 35 or 40%? Can it be down to $28? Sure, it can. But you're no longer have the risks of owning it at $45 and getting caught in a 30% correction. At this stage, a chunk of that correction is rear view. So now you could try to be fancy and market time this and say, well, if there's one more dip, I might get it cheaper and this and that. But the thing is it's either a commodity bull market or it's not. But I mean, at some point, the stock has already corrected a good chunk of it. You don't want to overthink it as well on buying it on the dip either, right?
Oh, I don't disagree, Patrick. I'm not trying to say that you can't trade during this time, but wait for your setups. Wait for them.
Right.
There's no need to feel uncomfortable because you're not seeing anything that is attractive to you. And that's all I'm saying.
So you heard it here on the huddle first. Buy Freeport McMoron.
Okay, next question.
Next question. You ready for it?
Yes, we're ready.
I'm never ready.
Theory. Powell will get fired in February and replaced by a more political chair. Fiscal will keep going until November 2022. QE will have to stay active to absorb Treasury and keep rates down, negative real rates. Any pullback in markets will be met with monetary reaction and fiscal policy to get assets back up. Kuppy's Project Zimbabwe or the guy Patrick cheats with. Crack a boom.
Is that what you guys call it on that show?
Yeah.
Oh, I didn't know that. Okay, sorry.
SPY will be at $500 by December 2021.
I'm giving it away that I don't watch it, but listen to it. But go on.
It's okay. Patrick doesn't read your letters either.
That's right. And
You know what's funny?
Someone doesn't
Twitter-
listen to this. That's why I can say things like that.
But it's funny. One listener on Twitter called me out on that. Like, I can't believe Kevin's not offended that Patrick doesn't read his letter.
You know what? People are busy, the first
No,
thing
listen.
So you do read them. I'm just giving you a hard
and
time.
yes, and you use technical analysis. This is just for fun.
Yeah.
All right.
Yeah.
Anyway, Lena, sorry.
SPY will be at $500 by December 2021 and $600 by November 2022. It seems a spread is a great way to play this. For example, a SPY December 2023, $600 by 625 call spread for $1.25. If we move up towards mid 500s, then the spread should multiply 3 to 4 times in value, which would be $6.25 ish. Calls are not that liquid, so it takes time to put trade on. Thoughts? Is there a better way to express this trade? Thanks.
Hey, can I just jump in? I know you're going to talk about it, but as I was reading this and thinking about it, this is completely Jim Leitner's trade.
This is what I was about to say.
Oh, I'm sorry.
You said that, no, that's okay. You don't have to say sorry. We're one of us. This is a digital option, right? Like this is.
Yeah, but this was almost exactly what he said in terms of picking something that's way up there. And for this listener, if you didn't hear that episode, go back and listen to Jim Leitner, because he loves these kind of trades and he recommends them, and he uses this as his direct equity exposure is through these things. And I remember asking him that and being shocked, because I was expecting him to tell me, oh, no, I got some regular equity exposure in this Vanguard fund or something that I hold. He just owns these as his equity exposure.
The interesting part, though, that's an important consideration to really reflect on is how to size that, because the spreads are so stupid cheap that the thing is that you have a disproportionate large amount of your portfolio in cash.
Right.
And so the question is, are you levered up based on delta dollars on the net spread or something? Like, it's a good question in terms of...
The other thing that I would give advice on in terms of, well, I'm not supposed to give advice. The other thing I would say for reflect on is the idea that you don't want to just go with one expiry. Meaning maybe you buy that one, and then when they list the next one, you keep doing it, because that's what Jim does. Jim has a series of different expiries and a series of different strikes.
Yeah.
So,
and he has the ability to go out beyond 2023 , right?
Yeah,
like
but
right now, December 2023.
I don't think he does, though. I think that's about what he does in terms of the length of his typical trade. But I do know that he'll do one this quarter, and then he'll buy another one next quarter, and it'll be a series of them, so that he doesn't just have one where it's all in on that thing. So that, if I was to give any thoughts about what to do, that would be my suggestion.
The benefit of this also is that it's a very defined risk. That's a benefit of all spreads in general, is that your risk outlay is the spread, and you know exactly what you're going to lose when everything goes wrong. And it's just a great way if you want to lever up your equity exposure. So you have a good component of equity, but you want to have that right tail kicker, that if things really get on fire, that you were leveraged up. These types of spreads are always an interesting way of doing that. Right?
So that's 35% out of the money. So 35%, and how long does that give you?
2+ years. That's the remainder of this year and basically the next two. So
it's probably a little aggressive. Maybe you.
Well, if you're going to have a crack up boom or Project Zimbabwe, that's not aggressive at all. Like, I mean, if you're saying if you want the steady 10% return, then yeah, that is aggressive. But that's not what this person's betting on.
That's true.
This person's betting on a crack up boom.
That's right. And if you are trying to maximize that payoff profile from a crack up boom, this is the way to do it. Right?
So a trade this way would do it. Yeah.
That's right. Like if you think this is what's going to happen, that would definitely be a way to do it.
Yeah. All right, Lena. Last question.
Last question. So from this listener, there's a few different points. One, does Alfonso Picatello have Lacey Hunt?
Even Lena screwed up.
See,
perfect.
even Lena, like she can't do it either. Nobody can do it.
I can't
There's
say
too many
either.
vowels in that name. I love Alfonso,
Alfonso-
but he's got to do something about that name.
Picatello have a Lacey Hunt poster in his room too. His views are exactly the same.
Yeah.
2, does Kevin have a poster of Stephanie Kelton drinking Labatt in his room?
He does. But anyway.
If the government controls spending, you get misallocation of capital like we saw with all the communist countries from 1945 to 1990. However, why not have the government provide more guidance or requirements on private lending, need smaller banks, community banks? This gets the private sector creating money and private sector allocating capital, but central government forcing them. Richard Warner talks about this on Princess of the Yen, where Japan provided lending guidance to banks. PPP also promoted private lending by backing loans. How about getting Richard Warner on the podcast?
Well, so first of all, if Richard's listening, we would love to get him on. It's an open invitation. Next about Lacey Hunt, I'm going to ask Alfonso if he has any posters of Lacey in his bedroom, and if he doesn't, I'll send them one of Patrick's extras.
I don't have extras. They're all.
I refuse to.
These are rare, vintage things that you'll have to pay up, Kev, if you want to send them.
And in terms of mine with Stephanie Kelton, that's true. I got Stephanie Kelton. I have Bill Mitchell and the other one as well. Oh, and I have Warren Mosler. It's when they did their greatest hits album, and that's what I have in my room. Okay, now I've heard this argument a lot recently. In that, and this is one of Alfonso's big points was. The government can't spend because the government's so terrible at spending. That's going to be awful, blah, 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 blah. And this listener has highlighted the fact that all communist countries spent and had directed investment from 1945 to 1990. I just like to highlight something that I think is being missed. If you think about the United States coming off of World War II, they went on one of the largest fiscal expansions and government spending infrastructure programs that we've ever had. And to a large extent, much of the United States' ensuing economic dominance can be attributed to those interstate systems and all the things that all those people coming back from war had created. So I take the other side of the trade that every single dollar the government spends is just money wasted and it's the end of the world. And I just think all you have to do is take it to its extreme and think to yourself, if the government stopped spending completely, what would happen to all of our bridges, all of our roads, and all of these things? And I am not trying to defend that the government is this great place that, it's going to be all unicorns and rainbows if we just let them hand out money. Because I'm the first one to say that chances are they're going to create inflation from it. But I will say that the opposite is not true either. That taking it all away from the government and not spending on infrastructure isn't the key to prosperity. And I don't think it's going to create an environment that is good. And in fact, I think that that's part of the problem with our policy is that we're so scared of the government doing it that we're not investing in our country. We're not spending. Like I take the great financial crisis and it boggles my mind that the private sector went into a credit contraction, meaning they had borrowed too much, they weren't spending enough. And what did the government do? The federal government, apart from one little bit of fiscal at the beginning, proceeded to then cut because they thought the debt was the real problem. And this was a time when interest rates were at all-time lows. And instead of the government going out and taking advantage of that by issuing bonds and spending, they did the opposite. They cut spending and went out and bought bonds. We didn't need more people to buy bonds. Everyone was already trying to buy bonds. We needed somebody to spend. And if the government can't do that in that environment and beat that hurdle, then I guess we don't have much else to talk about, because I'm fundamentally on the other side of that. I believe that the government should invest in our infrastructure. I think we should make the country a better place by fixing roads and doing things like that. And I think the time to do it is when the private sector is not doing that. Anyways, that's my diatribe.
All right. Well, thank you, Kevin.
Okay. And listen, there was more to it than that. And listen, this viewer or listener had some very sophisticated questions about other ways you can get credit creation through specific government underwriting specific programs in commercial banks. And I completely understand that it's just way beyond this. This is no stupid questions, and that would be almost a whole show on itself. But
we might even have a topic like that covered this summer. We'll see.
That's true. We might have someone talk about things like that. But I will say that I'm just so opposed to the idea that any sort of government spending on fiscal is bad. It doesn't have to be bad. And I contend that the reason that the United States is the greatest economic country in the world was not because they did so little infrastructure spending. It was, in fact, just the opposite. It's because they came out of World War II and they were in a place that they could do more infrastructure spending and that they could get ahead of everybody else.
Benefits when you have the world reserve currency, but anyway, let's not get into it. Let's get into another conversation another time on that. Anyway, Lena, where can they submit their questions for September?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com, and they will be answered in September.
Perfect. All right. Well, you know what? This is a great opportunity for us to kind of share with our listeners what we have planned here, right, Kev?
Yeah, so why don't you tell us, Patrick?
Well, after you tell us, Kevin.
You guys don't even know.
Well, we in terms of the plan, Lena, why don't you do it?
Oh my goodness.
Yeah, do it.
So, Patrick, the international man of mystery, is on the move for the summer, and so are you, Kevin. So we will be running, was it 5 episodes until September. That will be interviews, various different interviews with different guests, and there won't be talking charts or skin in the game or no stupid questions.
There we go.
Right. So we have some great interviews coming up. There will be one still every week, but we're going to get to our regular format after Labor Day.
Right. But there will be new content. It won't be a rehash of old shows or anything like that. There will be 5 specific new interviews that we have either pre-taped or in one or two instances, someone will be taking over our duties as interviewer.
Yeah, looking forward to it.
I
Anyway,
guess this was a taste of what's to come, the fact that we let Kuppy drive.
Yeah, so stay tuned every Saturday still.
That's right. Stay tuned. Okay, so thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle. We're there every day. Lena gets tired of talking to Patrick and I, so please give her a shout out. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, if you could, rate and review us on iTunes. Patrick, where can they find you?
You can find me at bigpicturetrading.com, or you can follow me on Twitter at Patrick Ceresna. Kev, where can they find you?
I'm on Twitter at Kevin Muir, or you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends, bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. Okay, so let's get this beer over with. It's undrinkable.
It's not undrinkable.
And listen,
we've had worse beers.
No.
You are the worst. You know what?
Good thing I see it's a small batch. I'm glad it's a small batch.
No, but like we basically had like, what was the beer that you rated ridiculously high just like a couple weeks ago? Like that was you have gotten like way off on your spectrum. like rating average beers like spectacularly high, and then you turn around.
No,
and
it was
take
the
beers-
beer from the listener from San Francisco, which was an outstanding beer.
No,
deserved-
that one was good. That one
deserved
we all
every-
rated that one high. We're talking about the one from a couple weeks ago. Anyway, the point is
We don't
is
even
that
know
you
which
you're just
I'm
being
gonna-
a sensationalist.
No, I'm
here.
not.
You're the-
I'm not.
Yeah,
I'm not.
Maybe your boomer taste buds are going.
Yeah. So
Yes.
listen, I'm not being sensationalist. This gets a.
I'm bringing you a Lapape.
This
That's it.
gets a 1-2.
What?
It's not that
You-
bad. We've
you-
had worse beers before.
You're going under 5 on this.
For sure, 100%.
Oh
it's
my
under 5.
God!
Anyways, just go on, Patrick. Give us
What?
your
Just
number.
because it's a dark lager?
It's not
Oh my
very
God.
good. Anyways, I'm calling it as I see it. I might be in a pissy mood. There's no doubt about that. But I'm just not in the mood for these dark beers. And this is getting
Now-
a 1-2. It's going to be my
All right.
lowest rating ever. But
So, okay.
And
So,
listen,
you know what,
Junction
Kevin, you-
beers. I love the other beers. Just this one. Good thing it's small batch.
Oh my God. Anyway, like Lena, I'm gonna rate this here, and I'm not gonna try to overcompensate on the top end to try to make up for him, but because generally I'm not a dark beer fan. I much prefer either like the IPAs or pilsners and things like this. So I'm gonna give this a 7.3. It's a drinkable beer, unlike what my co-host here is trying to brainwash everyone here. This is a nice beer, and you know what? I liked it. It was good. Anyway, Lena, what do you think of it?
I was about to give it a solid 7.2.
Oh,
so
there
we're
you go.
kind of on.
This
the
is
same.
just crap.
I finished it.
No.
Although, listen,
like-
I just checked the Untapped, which is some sort of beer review thing.
Rotten Tomato for beer.
Yeah, and I'm wrong. Oh, no. This isn't for this beer. I got to find the one beer because they're giving it for the whole Junction Brewery because the Junction Brewery deserves they're a good brewer. Like, let's just see if I got one for this one.
It can't all be winners.
Yeah, listen, and I get it.
To each their
Oh,
own.
no, I'm completely, listen, they like it. 3.66. So
Out of what?
I'm well off this. I don't
3.66 out of what?
5.
Out of 5.
Yeah.
Yeah, I guess I just
That's right about the range where I rated it. See, it's. I just think you were just being mean. You felt like you needed a punching bag today, and you just.
I'm not
and
going
you
to
said,
deny
"This
that.
beer
I'm not going
is
to deny that.
going
I
to
was in a
take
bad mood.
the
I was in a
abuse."
foul mood, and I'm not going to deny that.
There
But
you go.
I'm not gonna change my view though. Like I put the the tick stands, the trade stands, even if it's a low trade.
All right.
Now, so I want to change the topic a little bit here, because I want to just say, what is the over/under? The fact that we are going to want to enjoy the month of August by kind of taking less responsibilities and trying to enjoy a little bit of the summer. My bet is the stock market is going to go haywire and ruin the entire month of August and make me sit at a machine the whole time.
Well, Patrick, you can choose. You can flatten all your
You always have a
positions. You can
choice.
choose. You can choose to not do it. At least that's what my wife tells me.
No. I could listen. I could arguably do that for myself, but that doesn't change the fact that I have responsibility to my members.
Oh, that's right.
And publishing trades and active thing, and I'm not going to be flattening my positions. I'm just hoping that the market just stays reasonable. I don't need it to be calm, but I just don't need shit to be hitting the fan.
Yeah.
Right? Like I
hear
and
ya.
you know what? I just feel the fact that you are planning on trying to enjoy a great vacation yourself. It's just like the market is just gonna be a spoiler.
Oh yeah. Listen, I completely agree. That it's one of those things that when you want it to be quiet, it never is, and then when you want it to be busy, it never is. By the
You goochered it just now by talking about it.
yeah.
Well, hopefully, we'll see.
Okay.
We'll see.
By the way, I'm sorry if you're hearing the dog. He was good for the most of it. My old man dropped a couple of dogs off, and he has a large dog that's his. But then, unfortunately, one of their friends got cancer and couldn't keep one of these dogs. So we got this dog, and his name is Harry. And Harry is Lena. What kind of dog is that?
I don't know.
It's a little white dog.
He's a small cute. I want to say like a poodle mix, maybe.
No, I don't think
know.
so.
Is he like a?
He's a purebred of something. I'm not very good at those.
Is he like he's white?
A Bichon maybe?
Yeah, I was thinking maybe a Bichon or.
I don't know. Anyways,
not a Shih Tzu.
No. But he's starting to cry now, so I do apologize if you can hear it.
He needs attention.
His name is Harry. My wife and I decided he speaks with an English accent, and
I feel like every single Harry
he's
speaks with an
Harry
English
the
accent.
hunter, and he will not leave the cat alone. The poor cat just wants to be left alone, and this guy thinks he's the biggest, toughest guy around, and he just runs up to the cat. So he's unfortunately had to spend all days downstairs with me locked up. Anyways, so that's what you can hear with him crying. He wants to get out and do a little hunting.
Like Patrick when he goes moose hunting.
Yes, and so people think we're kidding that Patrick is going to come. We have to wait for this up for Patrick's moose hunting, and we're not. We're not.
You're gonna have to take some epic pictures when you do go moose hunting.
All
so
right.
people don't think that we're just joking around.
All right. But we're crossbow hunting this year.
Oh
so
my
it's not
goodness!
gonna be-
So listen, how often do you guys get one?
More often than not.
I have
There was a couple of years where we had dud years, but more often because it's a large group, so you're able to spread out pretty wide. So but this is the first year we're doing it with bows versus with rifles. So this is going to be something new.
So
why are you guys doing it with crossbows?
Because we wanted
instead of
to go
rifles?
to a closer area. The place we normally would go is like a freaking 12 to 14 hour drive to like.
a
nowhere.
closer area because
like
it's
we're only
harder
gonna
to
be
kill
fo-
them with a crossbow. You have to get closer.
No, because you can't this close to the populated areas. You can't.
Oh, because it's a big gun that you have to use. It's like a 308 or something,
and so,
right?
Yeah,
like
so basically you have to go up north to use.
Because you don't want the bullets flying everywhere.
Yeah, and so basically down here you have to use. They only allow bow.
Oh.
And so we figured we're gonna give it a try. That way we're only like 3-4 hours north.
So it's progressively getting harder, Lena. You see, like he starts with a gun. There's a huge advantage there. He's going to
soon
a crossbow.
soon it'll be a knife.
A knife, and then next thing you know,
it's gonna be a knife fight with a bear.
It's just gonna be like Patrick naked in the woods trying to kill this moose.
Oh my gosh, he's gonna be on that show, Naked and Afraid. Is that what it's called? Where like two people go out.
I'll pay
into
not
the
to see
wilderness,
that.
And they're buck naked. I think they can bring like two things with them. It's like basically Survivor but naked, and they have to survive the wilderness. I don't know if it's like a week or 2 weeks.
Naked and
or
afraid.
whatever.
And so, like, if
Yeah.
you want to bring some food, then you have to go. Oh, Harry, stop it.
I think you have to hunt it. Like you have to hunt your food.
Patrick, this sounds like everyone. Let's campaign to get Patrick on this.
Oh my god. No.
Come on, this would be awesome. You already know how to kill squirrel.
I have nailed that one down.
How many squirrels do you think you'd have to eat in a week to keep yourself?
Oh my god.
Oh my god.
Like, what would it be?
Can we change the topic?
He's probably like at least 6.
6? Oh, one a day only? No, you need more than that. Think about it. Like, like if you just ate chicken.
Well, considering the size of the Wagyu steak we all shared the other day, he probably needs to eat at least 3 a day.
Like, realistically, like I could eat 10 squirrels.
Oh my gosh.
Like, there's not much meat on the things.
Yeah.
Like,
that's
I'll
true.
bet you
It's
anything.
all
Like,
hair.
you go look at a wolf because wolf will eat squirrel. I'll bet you they can polish off a single wolf that's 100 pounds. That's like half my weight. I bet you he can eat 10.
Oh yeah, I'm sure.
Yeah. So like,
Oh my gosh, people must.
Are
think
we
the
are we
Canadians eat
yeah, are we
squirrels.
done? Like
no, we're not done. We're gonna figure out what your boots.
This is the last episode before September.
Yeah.
so yeah,
Where we are
we're gonna
all
end it
together.
with counting how many squirrels it takes to eat.
No,
to
but
sustain
honestly,
life.
you would need a lot of them. Let's face it, right? They're not that big. There's not a lot
Were
of
they-
meat.
Yeah,
were
you
they-
know, when I was in New York, I went to a French restaurant there where they were serving frog legs.
Ooh,
And
tastes like
those
chicken.
frog legs are probably about as meaty as a
squirrels?
squirrel.
Really? I wouldn't have.
Do they
I
taste
wouldn't have
similar?
pictured the squirrel to have that much meat.
Maybe a little bit less. But yeah, but bottom line is that like when I sat there, I think I went through probably like 6 sets of frog legs.
Oh my gosh.
It did see.
So it's 3 squirrels or 6
I
sets
could
of
just
frog
see
legs.
Patrick sitting there sucking the frog leg right down to the thing. Is it cartilage or bone?
It tastes like fucking
No,
chicken,
but
dude.
like it's on the leg, right? Like so.
Yeah.
So, but is it cartilage or bone?
Must be bone.
Oh, it's bone.
Oh, it is.
Yeah.
No, they don't. I don't think frogs have bones, guys.
No, but okay,
What?
but it's
like cartilage.
thick enough like that you can eat around it like a bone.
Okay.
Yeah, but it tastes like chicken.
Well, yeah, but it's a weird mix of it has a taste of chicken, but it has the texture a little bit like fish in a sense. It's light. It's very flaky almost.
Yeah.
But it does taste like chicken. You're right.
What does squirrel taste like?
It didn't taste good.
Did it taste like a rabbit?
No,
maybe?
I am so not looking forward to ever eating squirrel again.
You didn't prepare it right. That's the problem.
It could be.
You didn't sous vide it and then put it on the
I didn't get
grill.
Ma to make the squirrel stew.
And just so everyone knows, we Canadians do not eat squirrel on a regular basis. It was just
No, this is
It's just
this
Patrick
is
during
just,
hunting
Patrick.
season.
just no. This was a one-time thing that will not happen.
You know what I could just see? I could see-
You're just never gonna let me down.
Yeah, I could see Patrick out there hunting, like bored with his moose, trying to hunt moose, and then seeing a squirrel and taking this huge gun that they use because it's got to be like there probably if you shot a squirrel with that gun, would there be anything left? It would be like a miss,
no,
right?
just
No.
like a
Yeah.
poof. And it's
So I have to
gone.
tell you the story of my uncle. It was my uncle-in-law. I don't know what that technically is, but anyways, he goes moose hunting, and they're not very good at it, and they like drinking beer a lot. And many years they don't get one. And the one year they're there, they're drinking beer at night, and the stupid moose wanders into their campsite,
Oh my god.
and they still couldn't get it. Although I think they were drinking, so they just said, "Ah, screw it."
They were probably
Yeah.
really drunk.
Are you allowed to hunt them at any time of day, Patrick?
Yeah.
Like,
As
No,
long as
no,
it's
no,
during
no,
the
no. But no,
season.
you're no. You no. It's until dark. Like you
yeah,
have to-
so they probably didn't
that's
want to
good.
break the rules. Yeah. So the moose was just like, "Screw you guys, I'm coming by.
Coming
you
out
guys can't
after
get me."
dark.
And I've never had moose. What does it taste like?
Oh, it's delicious.
Is it?
Well, what does it taste like? Compare it to something.
Well,
Bison?
no, it's very very much like beef, but it's got a gaminess to it, like a slight gaminess. So that you can get that removed a little bit, but overall, like you can soak it in things like that. But it's red meat like moose. I mean, it's a cow that way. It's
Do you
just
guys prepare everything? Like you guys skin it and all of that?
Yeah, well, we take it to a butcher to actually do the
okay.
thing, but you have to gut it when it's out there.
Yeah, you have to get rid of all that parts of it. I can just see you guys. It just must be hilarious.
I think it gets messy actually.
Oh, I can imagine. You're gonna be
mean,
like
this thing is
you're
a
gonna
gargantuan
be like
animal,
the
right?
guy in American Psycho, with like a chainsaw and wearing like the full on plastic suit. I can just see you.
No, that's actually not the way it works. But
Here I am. I'm thinking Leonardo DiCaprio from The Revenant.
Yeah.
And where Patrick's just gonna crawl into a moose carcass to keep.
oh
warm.
my god!
Oh, like Empire Strikes Back with the tauntaun.
Oh my god. So,
I'm
Okay,
not-
can we? So what do you guys? So Kev, you're going on this trip. Are you looking forward to
I
it?
am looking forward. It's gonna be a lot of fun. Thank you, Patrick.
So you did decide to go past Alberta, and you guys going to make
I
it all
think
the
we
way
will
out
go
to
to the other coast. It will be fun.
Smart man. I personally thought that was going to be a big mistake if you didn't.
Big mistake. Yeah. Well, we'll see. You know what? That's if considering that as long as my wife and I don't kill each other by the time we get to BC, it'll be
Which
good.
is entirely
Yeah.
possible.
Everyone's like, "You're going for how long?" And you're gonna be going with the whole family.
in an RV?
Yeah, Clark Griswold style. It's gonna be a lot of fun. It will be
Well, I
fun.
wish you-
These
I
are the
wish you
kind of
best of
these are
luck.
the kind of things that you remember the rest of your life.
Oh yeah, for sure. It's a great idea.
When I was 16, we drove to Expo 86. My father took the whole family. We piled into the wood-paneled station wagon, the Grand Safari, And we drove, and we went from Winnipeg, and we went all the way through like the Badlands, and we went to Yellowstone, and then we went all the way to the top of California, then came up the coast, and then on the way back we did it all, and it's one of those things that I always remember.
That's an amazing road trip.
Yeah, and it was really fun because Expo 86 was a great time. We haven't had one of those in ages, right? I guess. Like, is there been an expo in the U.S.? Do they have those? They must, right?
I haven't heard.
Oh yeah, because the expo is like the original Chicago one, was it 1901 or whatever, when there was the very famous expo in Chicago. But it's been a while since we've had those. Do you know that like when you go to Montreal, you know how there's an island out there in the is that where they race?
Yeah, that is where they race.
That was originally the Expo 67
location.
I think it was Expo 67. That was original.
Wasn't it in the 80s? Oh my God!
No, you're so far off, buddy. Yeah, that was the original Expo 67. Anyways, okay. Well, Lena, what do you got planned?
Well, I'm going to be working for a little while, but I have a couple of trips planned in August.
Yeah.
And we'll report back when we're back together in September.
Oh, you're not going to tell us?
Just in case it doesn't pan out.
Oh, okay. I get it.
I don't want to goocher it.
Yeah, I hear you.
Things are slowly opening up.
Oh, you're worried about that.
Yeah.
Oh, you're worried about. Oh, you're going.
So I don't
you're
know.
going somewhere that it might not. That they might like stop you from traveling. You're saying.
Yeah. So I just want to make sure that I actually am able to get there before I, announce it everywhere, and then.
Oh, we could talk about it when we're back.
Yeah, it'll be fun.
Exactly.
Oh, but this is good. I mean, we're recording a little bit early, but you know what? We're gonna enjoy the summer.
Yeah.
And hopefully the stock market behaves and allows us to really enjoy it.
And I hope everyone.
At least for me,
hope
anyway.
everyone likes our guests that we've lined up. I think they were a lot of fun. There's a couple. There's one that when you hear it, you'll be like, oh, I bet you Kev wishes he could have done that interview. And there's definitely one that I wish I very much wish I could have done. But someone else will do it, and it's going to be awesome. And I'm going to listen.
Oh, he's going to listen this
I'm
time.
going to listen.
Nice.
All right.
Okay.
All right.
Have a great summer, everyone, and thanks for tuning in. And we'll see you after Labor Day.